Now, as you may know, I'm a big fan of Bitcoin, and some people perceive Bitcoin to be very risky, but to be honest with you, I think the banking system is much more risky than Bitcoin. Since 2020, we've seen 15 bank failures, according to the FDIC. Back in 2023, we saw two of the largest banking failures in US history, with Silicon Valley Bank going down and then First Republic Bank going down, two large Bay Area banks. And this was a warning sign to the world, to the people, that you might want to start storing more of your wealth outside of the traditional banking system. Just this year in 2026, we've already seen a bank failure. It was Metropolitan Capital Bank and Trust in Chicago. And with all the vulnerabilities that we're currently seeing with the banking system, I wouldn't be surprised if it's the first of many. Now, why do we see bank failures? The main reason is that this system is fundamentally flawed. The US banking system is a fractional reserve system. If you don't know what that means, it basically means that they can lend out all your money. And I believe that people have a misconception about how the banking system works. When you go and deposit your money at the bank, they don't keep it there. They don't keep it safe for you. They take that money and they lend it out in order to make a profit. I don't think this is how banking should work. I think that when you deposit your money at the bank, you're looking for a custodian, someone to watch your money and keep your money safe, but that is the illusion of the US banking system. Back in 2020, we saw that the government lowered the reserve requirement for banks down to 0%, which means that they don't have to hold any of your money. They can lend all of it out. This makes the banking system very risky. It leads to over leverage in the banking system, and it's probably what's going to lead to more banking failures in the future. Now, why do the banks lend out your money? They do it for two reasons. The first one is for investment. The banks would rather lend out your money and earn interest rather than let your cash sit there and not earn anything. The banks are a business. They're not there to protect your money. They're there to make money. The second reason is that banks need to support this credit-based system that we live in, and they really need to support the government. As you may know, the government, the US government, is highly indebted. We have around $39 trillion in national debt, and the government is constantly needing to issue more debt. They need someone to buy that debt, and one of the main buyers are the US banks. So the banks take your deposits, your cash, and they lend that money back to the US government so that they can go into more debt and the system can continue. We also see that the banks support other debt markets. If somebody has a credit card that they need to pay off, but they don't have the money and they need to take out more debt, what will the bank do? They'll issue them another credit card. If somebody needs to refinance a business loan or a home loan, what does the bank do? They lend them that money so that they can do that. So the banks are really responsible for facilitating this credit-based system and making sure that credit expands so it doesn't fall apart. As long as credit keeps expanding, this system can continue to work. But when the economy starts to weaken and credit starts to contract, that's when things start to fall apart. And we've been seeing some signs lately that the economy is not looking so hot. We just got revised job numbers for 2025, and they were down by over 1 million jobs, signaling that the job market is not looking so great. If you go on LinkedIn right now, you'll probably see a lot of open to works. I've heard from a lot of people in my local community that they're having trouble finding work. So the job market is not looking great, and that is not a great sign for the economy. We've also been seeing that prices have been falling, signaling weakening demand. You notice this when you go to the gas pump and gas is under $3 a gallon. That's because we're not producing as much. That's not a great sign for the economy. We've been seeing this with our Trueflation indicator, one of my favorite indicators for measuring prices. Let's go ahead and take a look at a little chart of that. As you can see, Trueflation has been falling over the past couple of months. It's down to 0.87%. We're also seeing rising delinquencies in areas like auto, credit cards, and commercial real estate. And what's one thing we know about government data? It's often understated, right? This data that we're getting is often inaccurate. If the economy is weakening and people are going delinquent on their loans, what does that mean? It means that the banks are taking losses. People are unable to pay back the bank. We also know that if the economy is weakening and people are losing their jobs, then people probably need money, right? To pay for rent, to pay for food, food, to pay off their other debts. So what are people doing? They're going to the bank and withdrawing their money. And the problem is, when too many people go to the bank and withdraw their money at the same time, the bank doesn't have it because the bank is a fractional reserve system. Now, one last thing I'll mention about the banks is that we already know they're in a vulnerable position due to their $337 billion worth of unrealized losses. So let's go ahead and take a look at a chart of that. As you can see in this chart, it does not look pretty. The banks are underwater. And the reason that they're underwater is because they took your deposits, your cash, and they made bad investments with it.